G'day folks, welcome back to Pete's Investing. We're looking at the SP500, the NASDAQ, the Japanese Nikkei, the GermanDax, and we're introducing the VIX Volatility Index for analysis. As well, we're going to show you the heat map, and bottom left here you can see the various markets are all showing bullish on the monthly, but all turned down to a bearish signal on the weekly and daily, with the exception of the Germany, which is still currently neutral. And our new indicator, or a new instrument here we're analyzing, is the VIX, the Volatility Index. That's bullish across the board, monthly, weekly, and daily. So let's start off with the VIX, the Volatility Index. On the monthly, it is currently bullish, although it's not showing us on the indicator down here. It's the way the chart is drawing it. On the weekly, it's showing a bullish signal, the CCI 150 above the moving average band, and on the daily, it's very, very strongly bullish. But just be mindful, we might see a bit of a decline starting to weaken on the daily and the weekly. So we might see a bit of a decline in the coming days, possibly. Now, if we jump to the daily and hourly charts, with a bit more detail, you can see here on the VIX, on the daily, it's in the oversold territory, and we may see a bit of a rise in the coming days, possibly. On the hourly, we've hit the overbought territory again, so you might see a bit of weakness in the coming hours, possibly. So just keep mindful of that. But we prefer to, if you're trading this, or if you're using it as an indicator for other instruments, then that's just giving you an idea that we've actually had a bit of a jump in the last few days, but we may see a bit of a decline or a hesitancy to go any further up. Now, if I zoom in, you can see there on the daily, the CCI 150 is still above the moving average band, as I said, still bullish. The ADX is still bullish. On the hourly chart, we've got again, because it's new, I haven't drawn all the divergences yet, but I'll show you the latest divergence. So if you see the lower highs on the CCI versus the same periods on the price chart, I'll take it right up to that level, that's still declining. So that's a bearish signal, which means we may see a decline in the coming hours. And the way we measure that as a minimum retracement, we draw a Fibonacci from the recent low to the current highs. That's assuming it starts declining as of this video, but it could actually go higher, so just be mindful of that. There's no guarantee it's going to drop from today. You can see there, had you drawn it up to that point, it did drop off, but then it started increasing from there again. So should it drop from here, then we're looking at a minimum retrace level down in the 23 to the 38% level. That's a minimum retrace level. So just be mindful of that. Even though we're showing bullish across all timeframes, we may see a bit of a weakening and a retrace in the short term. So now let's look at the S&P 500. And as you can see on the monthly, weekly, and daily charts, we're still bullish on the monthly, although it's turned down and broken through the moving average range on the weekly, and it has done so. We've been showing you a bearish divergence on the daily, and it's eventually started to break down, and we've drawn a target area in that little 23-38% retracement level between that low and that high of the Fibonacci. And again, for those new to Fibonacci's, that's that range there between a 23 and a 38% minimum retrace level. So we expect it to hit at the very least that level before making potential further bounces, or alternatively it may actually fall further. And we can't tell at this stage where it's going to stop, but that's a minimum retrace level, and about 90% of the time it does at least hit this level of divergence. On the weekly, we've also got a bearish divergence. That's that double top on the CCI is still considered a bearish divergence with higher highs on the price. So you may see it fall, and I haven't drawn a target area for that, but we may see it start falling further. And as soon as I see a few more declines in the coming days, I'll then draw a target area. Likewise, on the monthly, we've got a bearish divergence on the monthly versus the price chart, and again, likewise, I haven't drawn a target, but again, similar to the weekly, we'll draw that in due course once we see further declines if that eventuates. Now next, if I go to the daily and hourly charts, again, I've got that on a daily, I've drawn that target area, and if I zoom out, you can see there the stochastic market forecast has been in the overbought territory, and it's starting to slightly weaken, but nothing too dramatic yet. On the CCI 150 on a daily, as I said, it's been declined for a number of months now. So it's giving us this bearish divergence. It's starting to break down. On the hourly, if I zoom out first, you can see there it was in the overbought territory for a number of months, and it actually broke down past the 75 level. It's now approaching the 50 level, which is our key area. If it breaks below 50, it's going to get a lot more bearish. And zooming in, you can see that I've drawn a few bearish divergence here versus higher highs on the price. In each of those areas, it did fall back and hit our minimum target before making further upside. This latest decline is a lot more severe than these previous bearish divergence. So again, just be careful. You can see there initially broke down, hit our target. In this case, it fell well below the 100% Fibonacci retracement. And I did have a bullish divergence there. It bounced, hit our target. Another bullish divergence there, bounced, hit our target. And now the price is moving in line with the CCI. There's no divergence. So at the moment, it's still declining. Now, if you're going short the US market, because we've got on the US market, the monthly is still long, but the weekly is bearish and the daily is bearish, as I said. So you take predominantly short trades. So I'd wait for this CCI on the hourly to break below that moving average band down here. If it breaks below, that's where you enter the short trade, and you close it out when the CCI breaks into the moving average band, like you would have done there. You would have gone short there, and you would have exited the trade when it broke into the moving average band. And that was primarily because the weekly and the daily are showing short positioning with the CCI. So next we'll look at the GermanDax. So on the monthly is bullish. On the weekly, it's broken down into a neutral. You can see there it's broken into the moving average range. And on the daily, it's been declining for a number of months now, and it's actually broken to the downside further. And also approaching our minimum target range. You can see there's a bearish divergence. We've been drawing that for a number of months now. Likewise, on the weekly, there's a couple of bearish divergences there. The first one there, versus that point, it dropped, hit our target. And currently we're in a second bearish divergence, and we haven't drawn a target for that one yet. There is no bearish divergence on the monthly, unlike the US market, only on the weekly and the daily. On the daily and the hourly charts, first off on the stochastic market forecast, you can see there it's in the overbought. No dramatic drop yet. We talked about the divergence on the CCI on the daily. On the hourly, similar to the US market, we had a few bearish divergence on the CCI, and each one of those dropped and hit our minimum target area. Until more recently, it's actually declined a lot more after hitting our minimum target. This one has actually dropped below that 100% level. And at the moment, there is, let me just see, that price action is moving in line with the CCI, so no divergence. Higher highs on the CCI, higher highs on the price, no divergence. Now this is a bullish divergence. So again, you draw, when you see higher lows on the CCI versus lower lows on the price, that's a bullish divergence. So in this case, if we were to draw a retracement, we would draw from, assuming it starts rising from now, go back to the previous high before the divergence started, so you take it back to that level, and our minimum, get rid of that. Our minimum target range would be that 23 to 38% level. That's our minimum target. So before it takes any further downside. So again, as a trading idea, you take predominantly short trades because the monthly, weekly, and daily, the weekly and daily are in a bearish position. So you take predominantly short trades and you wait for the CCI on the hourly if you're trading the hourly, but when it breaks below the CCI, this moving average band. Of course, I'm showing you the 1 hour chart here. You can apply to the 4 hour, the 2 hour, the 15 minute, the intraday charts traded, determined on the larger time frame trends. Next, we'll look at the Japanese Nikkei, bullish on the monthly. It's broken down to a bearish signal on the weekly, and it's been bearish for a number of months now on the daily. Again, there's no bearish divergence on the monthly. On the weekly, however, you can see there's a bearish divergence still in play. I haven't drawn a target. I'd like to see it break a lot further. And on the daily, I've already drawn a target, and it hit that recently, and it's dropping further to this support at 38,300. So again, bearish on the weekly and bearish on the daily. It's still bullish on the monthly, but you can relatively safely trade it on the weekly and daily trends at the moment. Going to the daily and hourly charts, again overbought on the daily. Hasn't made any major breaks yet to the downside on the stochastic market forecast. On the 1 hour chart, that's actually broken down just above the 50 level, so it's almost reaching that cross point to be more bearish. And as I said, on the CCI 150, we had a few bearish divergence similar to the other markets. They dropped, hit our targets, and more significantly later, we did see it break a lot down to the 100% level to this support area. Now, we did have a couple of bullish divergence. You can see there, higher lows on the CCI versus lower lows on the price, bounce hit our target. This one actually also hit our target, even though it declined, it bounced. And just so you understand how it works, I draw a low from that low to that high before the divergence started, and you would have hit that target area down to that 38% level. You can see there it touched it, broke just above it, then it dropped further after it hit its minimum target. So again, always go for this minimum target. Don't get too adventurous and too risky by going to a lot higher targets. In this case, it dropped off and there is no further divergence. Those lows, lower lows on the CCI and lower lows on the price, so they're moving in line with the price action. And lastly, the NASDAQ. On the monthly, it's bullish, although we've got a bearish divergence, you can see there. On the weekly, it's turned down into a bearish signal. It's broken down below the moving averages. Also, we've got a bearish divergence versus the price chart, higher highs versus lower highs. And I've drawn a target area there between that low, actually it would have been between that low and that high. That's our minimum target range. And on the daily, it's been in a bearish divergence for a number of months as well. We've been projecting this for a number of months now, and it's eventually bounced down from that resistance at 18,465, and it's actually hit our target in the last couple of days of trading. On the daily and hourly charts, you can see there on the stochastic market forecast, it's still in the overbought territory. No significant down swings yet. On the hourly though, it's actually bounced down and punched through the 75 level and approaching the 50 level, and if it breaks below that, we're going to see a lot more bearishness. And again, similar to the other markets, we had a bearish divergence along the line, along these various highs and lows, and they've dropped and hit our minimum targets. And more recently, we had this two bullish divergence. That first one down to that point there, that was the first instance, and that broke up, hit our target. And the second level was a bullish divergence versus double bottom here on the price. We drew a Fibonacci between that point and that high, bounce hit our target. That went almost as high as 100% level before collapsing again and making new lows. And likewise, we've got, you can just looking at any divergence, those peaks are lower, so that's no divergence, and those lows are lower, no divergence. Although, looking at it very closely, you can see we've got higher lows on the CCI, so versus the price, so between those lows versus the same period between that point to there, it's a bit hard to see, but that's a bullish divergence versus lower lows on the price. And to draw a minimum retrace, you go up to that level. And just a reminder, I don't trade these retraces up, whether they're bullish or bearish divergence. I use them as an exit signal, as one of the indicators for an exit signal. So if I'm going short and I see the CCI making higher lows versus lower lows on the price, first of all, you would have exited this short trade if you had gone short at that point there. So long as the weekly and daily in a short environment, I would have taken that short position there, going short on that bar, and I would have closed it out once it broke into that moving average range on that bar. But to add extra support to that exit theory, if you see a higher lows, like you are seeing here, versus lower lows on the price, that just gives you an extra reason to get out of the short trade. The same goes in the opposite direction. If you're going long and you're seeing a bearish divergence, get out of the trade if the CCI doesn't give you the warning. To support us more, go to the Patreon page for Pete's Investing, where we also do weekly scans of blue chip shares that are trending along on a longer and medium term timeframes. Feel free to support us there, and we'll see you in a future video.